All right. Good morning, good afternoon, traders. Today is Friday, May 16th, 2025. This is You've Got Options for Income Navigator. Today, we're going to talk about trading put options. We're going to look at bullish, bearish positions using puts. We're going to look at some ways to generate income, some ways to hedge your portfolios or individual positions and whatnot. And, this is pretty basic. It shouldn't be too complicated. First, we're going to start with let's just kind of set the stage, right? Today's objective, we're going to try to master put option strategies, long puts, short puts, income protection, and so on and so forth. Real quick, for those that are not familiar, what are put options? Right? Put options are contracts that give us the right, if we're buyers of the puts, to sell stock to somebody else at the strike price by certain date, also known as expiration date. And put options can be used as bearish bets, and they also can be used for hedging purposes, and they can also be used for income generation. Let's start with very simple long puts. Okay. And what I'm sharing on my screen, this is Microsoft. Today, Microsoft is trading at 450.17. Why Microsoft? Because why not? Right. Let's look at the chart. Microsoft has had quite a run. Right. So that's why I thought this was kind of a decent example. Now, again, this is not a financial advice. I'm not telling you what's going to happen. I'm not telling you what you should or should not do with your money. But looking at the chart, right, we're quite a ways away from the 50-day moving average, from 8 and 21 EMAs, right? So the market is bullish. Price is above all key moving averages. MACDs are stacked bullish. They're above zero, so there is some sort of a trend, I guess, short term here. But RSI is getting a little bit overbought here. And if we look back, right, and it doesn't always work, but for the most part, we have to assume, right, that some things can repeat. The last time we had a decent run up in the price of Microsoft, right, very similar setup above all key moving averages. MACD was all the way up and also was kind of bullish, but it was already kind of starting to roll over. We're not really seeing that just yet. And you can see that RSI, it was already pretty extended and overbought, but we can stay overbought for quite some time. So that's why I don't think that, Microsoft is going to roll over and die here. But if you wanted to, make some bearish assumptions, it's not a terrible spot to do so. That's why I picked Microsoft. So long puts. What is a setup for a long put? Remember, a put option gives us the right to sell the stock to somebody else. I think using long puts is a great way to replace stop losses. For example, if I own shares of Microsoft at 450 a share, and I'm concerned that maybe I'm chasing up here and that maybe the stock is going to go down, right? We have a pretty big gap that was after earnings. Now we're concerned. We think that the stock may go back down. It may not hold 8 or 21. Maybe we come down and test the 50-day because, last time we had a similar setup, right? Microsoft came down quite a bit. So if we are concerned, right, we can put a stop loss. Say maybe we wanted to get out of the stock if it goes to 440, right? We're risking 10 points. But what happens if there is an overnight gap, right? Maybe a couple of days in a row, maybe, but let's talk about a gap, right? Today, Friday, Monday morning, market opens and Microsoft's at 430. Well, if I put a stop at 440, guess what? My stop is going to turn into a market order first thing on Monday after it gets triggered, and I will be executed at market, wherever the market may be. Maybe it's 430, maybe it's 420. We don't know. So putting a stop at 440 really doesn't get us out at that price. That's why buying long puts gives you the right to sell the stock at the strike price to somebody else. So if I, instead of placing a stop loss, go out and buy a 440 put, right, maybe 63 days out. So until July 18th, I have the option to put the stock to somebody else at 440. I don't care if it's at 430. I don't care if it's at 420. I don't care if it's at zero. I have the right to sell the stock at 440. Now, for that right, I have to pay a premium. So if I go out and buy a 440 put with 63 days until expiration, I have to take $920 out of my pocket for this right. Okay. My outlook has to be bearish, right? Maybe I am protecting a long position. Maybe I'm just taking a shot, right? Seeing this setup, thinking that the market or the shares or the price of Microsoft may be overextended. And I say, you know what? I'll take a shot, see if we come down and maybe start to fill the gap after earnings or something like that, right? So I don't have to have the stock to necessarily buy a long put. Maybe this is just a bearish bet outright. So my outlook has to be bearish, as you can see, by buying one out of the money put option. My delta is minus 36, which means that buying one out of the money put will get me an equivalent position of being short 36 or 37 shares of Microsoft. So my outlook has to be bearish. If the stock rallies, looking at the delta, this tells me that I will lose about 36 or $37 for every 1 point that Microsoft trades higher. Same thing on the downside, but in reverse. If I am right and the stock does start to trade lower, I would expect, just from my delta reading, I would expect to make about 36 or $37 for every 1 point that Microsoft sells off. Okay. And we can look at Vega reading. This is very important here, is that not only are we bearish, but we're also bullish on volatility. So if the underlying is going to go down, what also is going to help us is a spike in implied volatility. So we're bullish volatility and we're bearish price or bearish direction. Our cost is whatever the market is trading at for this put at the time. So right now it's at about $920 or $9.20 per one share. And that is my cost. And also that is my max potential risk in this trade. If Microsoft goes down, I will make money, right? But what if Microsoft does not go down and instead it actually goes up to $500 a share? Well, in that case, by expiration, if Microsoft's at 500, I cannot lose any more than what I am paying for this put option. So it's a great way to define your risk if you are taking a bearish bet. It's also much, I guess, cheaper or maybe it's simpler than going and shorting stocks outright, right? Because to short 36 shares of Microsoft, you will have to pay the borrow fee. It may not be a lot, but if you're going to hold it for 63 days, right, there's definitely complications with shorting stocks. And if you're short shares and the stock rallies, right, being short gives you exposure to potentially unlimited risk to the upside. Whereas buying a put outright, you define your risk, you know exactly what's at risk. And if you're right and the stock or whatever the underlying may be goes down, you'll make money. If it goes the other way, well, you can't lose any more than what you bet on this strategy. So we know what our max risk is and our potential reward. Technically, it's not unlimited because stocks could only go to zero. So the difference between 450 and zero, that is what this put can make on the downside. So the most you can possibly make is 450 points times 100 shares. You do the math. So that's for the long put. Let's have a look at if I buy a 440 put, right? What's my downside break even? Well, my downside break even here is my long strike, right? Which is 440 minus whatever I'm paying for it. So in this example, I need the price of Microsoft at expiration at around, let's just round this off to $10. So it's 440 minus 10 at around $430. If Microsoft is at 430 or lower at expiration, this is going to be a profitable trade. If Microsoft is somewhere between 440 to 430, there will be a loss, but it will be less than the total amount of premium we're paying for this. The only way I lose 100% of this premium is if Microsoft is at 440 or higher at expiration over the next 63 days. Okay, so I think it makes sense to, um, if you are buying puts and you're making a bearish bet on the price of the underlying, that you want to keep an eye on the chart, right? If something changes, right? Maybe you have a slight pullback and a sharp rebound, right? Maybe the price is not as bearish. The longer you hold this option, I want you to look at your theta reading, right? So negative theta tells us that every passing day is not working in our favor, right? Every passing day, we're going to, or we should expect the value of this put to decrease by about $10. Okay. And if something changes, right? If the stock is just not moving, you definitely want to give yourself enough time to be right, but don't get caught up into or don't try to prove something to the market, right? Just because you're in a position, you have to recognize when you're wrong, and you definitely want to get out of the way because as the time runs out, right, we can see that theta reading, like right now, we have 63 days until expiration, and the theta reading is minus 10. Well, if we go 40 days into the future, right, theta reading increases almost 60%, right? So things are going to accelerate as we near expiration. And this is with 23 days. If you go another couple of weeks, you will see that theta will completely take over. And by then, you might have lost 80% of the premium that you paid, unless you decided this was a full risk trade, which is also another way to define your risk. For example, if you wanted to risk no more than $1,000 for the trade, and you said, you know what, I'm not going to use a stop. If I'm wrong, I'm out $1,000. It's within my max allowable loss per trade guidelines, and that's fine too, right? So you do have to be aware that time is not your friend here. Okay. So maybe you say, all right, I'm willing to take a bearish bet, but I don't think that Microsoft is going to necessarily, you need 430, which is not a stretch, right? Somewhere between 8 and 21 EMAs. It's also, kind of inside of this area that we had chopped around in, late last year. So, it's not a stretch, but, putting out 900 and or, $1,000 to make a bet to the downside over the next couple of months, maybe you don't want to risk that much money, right? So you may consider doing a vertical spread, right? Where you buying a put option and then you're going further out of the money, right? So you spend $900 to buy the 440 put, and then maybe you go out 10 points further out of the money and then you sell a put, right? By selling 430 put against the 440 put, we reduce the cost of the 440 put from $917, right? We're collecting about $660 for the 430 put. Now our cost of this spread is down to $260. So instead of risking $920, we're only risking about $260, right? That sounds like a better deal, right? It is, right? Because now, again, our risk in this spread now is limited down to the debit that we're paying. Instead of 920, we're only paying 260. Great. We cannot lose any more than what our cost is, or $260. And that is if the price of the underlying at expiration is above the long leg of this spread. Okay, so anything 440 or above at expiration, we're out 260 bucks. Our downside break even is now the long leg of this vertical spread plus the premium that we're paying, or $2.60. So 440 minus $2.66 we're somewhere around 437 and change, right? So at expiration, we need 437 and a half or lower for this spread to make us money. So now we know the risk, we know the downside break even. What is our max potential reward for this trade? If we are right, and if Microsoft say goes to 420 at expiration, well, our downside here is limited to the difference between these two strikes, 440 and 430, which is 10 points, right? 10 points per share times 100 shares, because each spread will cover 100 shares. So we have 10 points times 100, right, equals $1,000. That is what the max potential value of this spread is at expiration. It's $1,000. Let's not forget we're paying $260 for it, right? So we have to back out $260. So we do 1,000 minus 260, right? So the max potential reward is $740. So essentially, we're risking 260 to make upwards of $740. We cannot make any more. Why? Because if Microsoft is at 420, right, both options are now in the money. What that means is that if we're going to put the stock at 440 to whoever bought this option or whoever sold this option to us, right? Someone sold us 440 since we're long. So we turn around and we sell the stock at 440. Well, we also bought the 440, but we sold the 430, which means that whoever bought the 430 from us, they're going to turn around and put the stock back to us at 430. So if we are selling the stock to someone at 440 and someone is selling the stock back to us at 430, the most we can make is the difference between these two spreads, or $1,000. Right? We're getting long at 430, we're getting short at 440, right? So we made $1,000 and we paid 260 for it. So we end up making $740. Hopefully that's clear. And also you can, kind of look at risk reward and the odds, right? If we're risking 260 to make 740, which sounds like a good deal, right? 260 to make 740. That is, about a 285% return, something like that, right? But the odds of this spread making at least a penny or more at expiration is about 64%. Right? So we have a pretty decent risk reward, and the odds are pretty decent. It's not a coin toss. So that's a pretty good setup. You get to reduce your cost, right, for the put. You want to make a bearish bet. You don't have to put up a lot of money. You're giving up some of the potential reward in exchange for drastically reducing your cost of this long put. Because let's just go back for a second, right? So at 420, this spread is worth $740 at expiration. Well, what if we didn't sell that 430 and we just did a long 440 at 420 at expiration, right? Instead of making $740 at 420, our 440 long put is worth 20 points, 20 points times 100 is $2,000, but we're also paying $920 for it, right? So we back out 920, so 2,000 minus 920. Our profit at 420 would have been about $1,080, right? So we make more with just one long put, but we have to risk more. If we want to cut our risk down, we go with a spread. We reduce cost, but we're also giving up some of the potential reward in exchange for that, right? There's always two sides of this coin. There's the good and there's the bad. The good is that we reduce cost. The bad is we're giving up some of the potential reward on the downside, right? So the only difference between a long put and a vertical spread is that we are selling a further out of the money option to cut our cost. Hopefully, this makes sense, guys. We're going to move on to bullish strategies using puts. And this is one of those strategies that you might have heard. You can use it to generate income. This is just a short naked put that is out of the money. And I just want to remind everybody that, you don't have to, buy puts or spreads that are at the money, right? You definitely don't want to do it in the money unless there's there's a purpose for it. You can go at the money, you can go, slightly out of the money. You can choose, right? You can look at the delta and decide, how far out of the money you go. For example, in the example of this Microsoft, you can, go out and buy something that's like, a delta 7, right, at 385. Maybe you just go and buy a long put. Well, okay, your cost is only $167. That sounds like a hell of a deal, right? But if you look at the probability, right, the probability of this trade or the probability of Microsoft going below the downside break even, which is all the way down to about 383 and change, the 90. It's safe to say there is a like a 93% or 95% chance that this trade is going to lose money. It's a really, really, you know, um, shot in the dark, right? Like if you wanted to just, do like a YOLO bet, maybe ahead of the earnings or something like that, right? That the stock was going to move in excess of 15 or 16% in the next 2 months, you go really far out of the money. Maybe you don't have to do a spread, but I wouldn't expect too much because there's a very high probability that this put is going to expire out of the money, right? And the closer to at the money you move, the more it's going to cost you. But at the same time, as your cost is rising, so is your probability of profit, right? So those are going to always move hand in hand. Now, if you are saying, well, who in the hell would want to buy a 385 put and lose money, almost nine, maybe, um, let's call this 9 out of 10 times. It's probably more than that, right? Like maybe 95 out of 100 times you should expect to lose money buying this, right? But somebody's on the other side of this trade. Someone's willing to sell this put. Why? Why would somebody want to sell a really far out of the money put? Well, maybe they don't think that even if the chart looks, you know, um, extended, and maybe near term expectation is that the price is going to pull back. But if you don't think that the stock is going to go all the way down to 385, right? This is a really high probability trade setup. You short the far out of the money put, you take in the premium, and that is your max potential reward, right? But now you have the obligation, not the right, but an obligation. If you're selling this put, you have the obligation to buy the stock at the strike price by expiration. What that means is that if Microsoft is, let's say, at 380 at expiration, you will have to buy the stock at 385 from whoever you sold this put to, right? So you have the obligation. You can't just say, no, I'm not doing it, get me out, cancel the trade. Like, it doesn't work that way. So if you're going to take in the premium, which is the great thing, right? You're generating income. You take in that $165 premium, you put yourself on the hook, right, to buy the stock at 385 anytime before or at expiration. So there's a trade-off, right? Instead of paying money for something, you're actually collecting the money. Now, you don't have to go this far out, right? Because, you know, you may say, well, even though the probability is great, right? I don't want to make $165. I would be willing to take a little bit more risk, right? And go, maybe you'll go, let's see, stock is at 450. So, we could use at the money options to give us, more or less an estimate of what is expected right now by combining the cost of the call and the cost of the put. So the calls are going for about 16, puts are going for about 12. So let's round this off to about 30 points, right? So the market right now is anticipating about plus minus 30, right? So at 450, downside expected move is down to about 420. All right, maybe you say, all right, you know what? I'm willing to sell a put maybe slightly outside of the expected range, right? Maybe we'll go to 410. Okay, it's a 15 delta, right? We could use delta, right, to give us an estimate of, what is the estimated probability of profit. And the way we do it is we just take the delta. So delta 15 tells us that there is about a 15% probability that 410 will end up in the money at expiration. So we have to assume that there's about an 85% probability that this 410 put is going to expire worthless. Right? It's still a very high probability trade. Our potential reward, our income, is limited to the premium that we're collecting. So we're collecting $340. And to put this trade on, let's assume it's a cash account, right? If you do it in the portfolio margin account, it's way lower if you do it in the margin account. But if you wanted to do it in some kind of a cash account, maybe it's an IRA, and you have to put up, right? You have to put up cash to secure this position. What does that mean? Well, if you're selling a 410 put, you have to assume that at expiration, you will have to buy the shares at 410. At 410 times 100, right, you have to put up $41,000 to do a cash secured put sale. Right, so you're putting up $41,000 to collect $3.40. Okay. That sounds like a decent deal, I guess. You can, put some numbers on it real quick. Let's assume we're going to make this 340 and we will not get assigned. $340 over 63 days, right? We're getting about $5.23 per day times 365 days in a year. So over the course of the year, we would assume that we could probably collect about $1,910. If we have to put up $41,000 to do it, right? So this is about an annual rate of return of about 4.65%. That's return on that $41,000 that you have to put up in order to do this trade. Okay. So would you be willing to, right, make about a 4.5% return with about a 90 or 85 to 90% probability, meaning that, maybe 9 out of 10 times you will not have to buy the stock. And if you do have to buy the stock, you buy the stock at about a 10% discount to today's market price. Right? This is a great way to use this strategy to acquire shares at a lower price And instead of putting a buy limit order at 410 and wait for the stock to come to you, right? You are already committed halfway, right? You have to put up $41,000, but you don't own the stock. So any you don't collect any dividends, you don't go to the shareholder meetings, you get nothing. All you have is the obligation that if the stock is below 410 at expiration, you have to buy the shares. So worst case, if the stock is below 410, you have to buy the shares. And maybe you were willing to buy the shares at 410 when the stock was trading at 450, right? So you have to kind of decide that with yourself. Are you willing to buy the shares? If yes, you put this on. If nothing happens, if the stock goes down a little, if the stock goes down, you know, maybe it goes down only 5%, right? But does not reach the 410, or if the stock rallies, instead of sitting on a buy limit order at 410 and not getting the stock you want to own at 410, well, at least you will have generated about a 4.5% return on the money that you had to put up to secure this position. Right, so that kind of makes sense. You can put a buy limit order and wait. If nothing happens, if you don't get that price, well, your buy limit is going to sit there for 6 months until it expires, and you have no shares, and your money is just sitting there not doing anything. Maybe it's in T bills and whatnot, but what if you have the money in T bills and you're collecting, whatever T bills are paying you, but then you also sell the 410 because you're willing to own shares at this price, right? So you're getting whatever T bills are paying you, plus you're also generating, right, a 4.5% return. And, this is annualized, so it's not 4.5% return every, 63 days, but it's not a terrible deal. You just have to, pick quality stocks that you're willing to own, maybe in your retirement accounts, and pick your spots. Maybe 10% discount is not enough. Maybe you want to go lower. And the farther out of the money you go, the safer your position is. However, the problem is that the farther out of the money you go, you can see that the premium drops off quite a bit. And then, before you know it, you go from 410 to 390 and you almost lost half of the premium. Right? So not a terrible way to generate income, right? Also, not a terrible way to get long stocks you would like to own. And while you're waiting, you make some money. Well, at the same time, what if you say, well, I would like to make the income. I don't really want to own the stock, right? So I have no interest in buying the shares, but I also don't want to put up $41,000 to do it, right? I don't want to put up $41,000 to do it. I would like to make some income in the meantime, and I have no interest in owning shares. Well, what you can do is, because selling a naked put, the downside or the risk is not necessarily unlimited because stocks could only go to zero, but it's quite a bit, and you will have to put up quite a bit of margin, even if you do it in the margin account, right? I think in the margin account, you would have to put up, I would say, somewhere around $4,500 to do it, right? What if you say, you know what, I don't want to sell this option naked. I've heard horror stories and I don't want to do it. So maybe you have an alternative by defining risk. What does that mean? Well, you sell a put at 410 and then you go further out of the money and you buy a put, right? You buy a put. You still get to collect the premium. It's just going to be less premium. Why? Because if we're selling 410 and we're collecting 330 for it, right? $330. That's to you plus 330. But to cut our downside risk, right, by defining your risk, we have to go out further out of the money and buy a cheaper option. Maybe we're paying $245 for it, right? So that's minus 245. If we do a math real quick, we do 330 minus 245, right? you get to collect, instead of $330, you collect $85, right? So your potential reward is reduced by the whatever you're paying for the wing or for the long option that defines your risk. Okay. How much money do we have to put up to put this trade on? Well, we have to put up the difference between these two strikes, because if Microsoft is at 380 at expiration and both long and short put is in the money, they have some value. What is their value? Well, at 380, right, the 410 is going to be 30 points in the money. The 400 is going to be 20 points in the money, right? So the difference between 30 and 20 is 10, right? So this put spread is worth $10 and the stock moved against us. So we're minus 10 points times 100 shares. We're out $1,000. But remember, we collected $85 for this spread. So our total loss gets reduced by that $85 credit. So if we back out $85 from $1,000, we end up with a loss of $915. That is the most that this put credit spread can lose, is $915. I don't care if Microsoft's at 380, if it's at 370, if it's at 200 at expiration, we cannot lose any more than 915, right? Our risk is defined, because what's going to happen is we are on the hook at 410, but remember, we bought the 400 put, which means we could turn around and put the stock to somebody else at 400. So if we have to buy shares at 410, but we also have the right to sell it to somebody else at 400, we're only going to lose about $1,000. Plus, we had collected $85 to do this trade. So we're out $915. It still is a very high probability trade setup, right? Because if we look at downside break even, which is the short put strike minus the premium we're collecting, right? So 410 minus 0.85, our downside break even is 409.15. So for as long as Microsoft is above 409.15 at expiration, this trade is going to make something. Best case, right? Microsoft ends above 410, we get to keep the $85. Now, if we are below 409.15 at expiration, that's where we start to lose money, and our losses are capped at 400. Anything below 400, we cannot lose any more than what our margin requirement for this trade is. Right, it's still a pretty high probability trade setup. We can look at, what's our downside break even, about 409. So we can still use 410 as a proxy, right? So 410 is a 15 delta. There's about an 85% probability, maybe a little bit higher, 87% probability that we're going to be somewhere above break even at expiration. Okay, so very high probability. And now we can also do some back of the envelope calculations as far as risk, reward, and the odds. Right, so if the most we can possibly make is $85 and we are risking $915, that $85 gain on $915 of risk represents about a 9.28% return on risk. Right, so in the next 63 days, as long as Microsoft stays above 410 at expiration, we will make about 9.2% return on margin that we have to put up to put this trade on. And we have about an 85% probability of making this profit. Not a terrible trade setup, right? Let's just really quickly look at the Greeks. What does this position Greek tell us? Our delta is positive, right? So we're bullish on price outlook. If the stock goes down, right, this put credit spread is equivalent of being long 3.7 shares of Microsoft. And that's going to change over time, over price and over volatility. But assumption, right, the price or directional assumption is bullish. You have to be bullish. If you're bearish on the price, maybe this isn't the best trade to do, right? But even if you're bullish to neutral, right, looking at this chart, you're saying, you know what, maybe if there is a pullback, it's not going to go, and pull back any further than maybe 420, right? We expect the 21 EMA to come in for support. So at 420, it's not going to be fun, but, you know, at expiration, even if we're at 420, right, you can be wrong on direction, but you will be eventually right as long as the price is above the short strike at expiration, right? So you don't have to be right away. You have to be right eventually. So directional exposure is bullish, right? Positive delta. Gamma tells us about the shape of this t plus 0, right? Whenever we have negative gamma, this means that if the move is against us, our directional risk is going to increase. And as you can see, at 451, we are long 3.75 shares. At 440, we're long 5.41 shares, right? So delta goes from 3.8 to 5.4. If we go down 10 more points, our delta almost doubles, right, to almost 7, from 3.8 to 6.9, and so on. And the farther or the closer towards the short strike the price is going to move, the more directional risk we're going to pick up. And that's a function of short gamma. The good news is we have time that's working for us. Right now, we're, plus 1 and change positive theta, which means that if nothing happens every passing day, we would expect to make about $1, just simply due to time passage. Right? It's a very light number because these strikes are very close, right? Our short put is positive delta. Our long put is negative delta. Our short put is closer at the money, so it has a higher theta reading. That's why we end up with a net positive theta. So for as long as nothing is happening, right, we would assume that we're going to make money due to time passage. We are also short volatility. We are not expecting volatility to rise. Even if we get a pullback, if it's an orderly pullback, right, and the market's not crashing, no problem. Eventually, volatility is going to contract enough to where we're going to make money. And let's have a look. You can look at projected T plus 0 lines, right? This is what expected T plus 0 line look like out into the future, right? So the red line, if this green line here is T plus 0 today, right? This is 63 days out. The red line is T plus 16, right? This is projected T plus 0, 16 days into the future. And if you pay attention, right, today our break even is about 451 and change, right? If we let 16 days go by and we're still where we are right now, we would expect this trade to be up about $20. And our downside break even is going to shift. You can see this is the 0, right? This is our make it or break it, so to speak, right? This is our $0. Anything above is a profit, anything below is a loss. So if today our break even is right at 451, in 16 days, our downside break even is going to move out to about 446, right? So it's about a 5-point improvement. The next line here is T plus 32. This is 32 days into the future. You can see our break even now moves even further out of the money, right? Now our break even in 32 days is down at about 440. So it's about a 10-point improvement over time, right? And that's because this Software is assuming that over time, volatility is going to contract and the value of these puts is going to decrease due to theta or time passage. So these are not guarantees, but these are projected T plus zero lines out in time. And you can use that to give yourself an idea of what to expect as long as, we move within what is currently being expected. Now, if we start to move, outside of expected range and volatility is going to rise, I want you to pay attention. Let's get rid of all these lines here. Just look at the T plus zero, right? This is T plus zero. This is P&L today. If I just start to bump volatility up a little bit, you can see how T plus zero will sink. And just from a volatility increase of about 10 points, this is like VIX going from 20 to 30, right? The T plus zero will sink and we're going to have a loss, about $70. And if the price is going to move lower, right, now we have our positive delta is working against us, right? If the price is going lower, our positive delta is not working with us, it's working against us. So we're losing money due to positive delta, and we're losing money because we're short volatility. And if volatility goes up 10 points, well, you can see that our Vega reading is telling us how much we should expect to make or lose for every 1 point change in implied volatility. So if the underlying goes down and volatility goes up, our positive delta and our short Vega are going to both work against us, and losses could start to ramp up pretty quickly. So you also, before deploying this trade, you kind of want to think about, what's your price outlook? Are you bullish or are you bearish? Maybe you're, bullish to neutral, which is fine. What's your outlook on implied volatility? Right? Would I want to put this trade on when implied volatility? I looked earlier at Microsoft IVR, which is implied volatility rank. And hang on one second. I'll have a look again. Microsoft IVR right now is at 9, right? That means that implied volatility for Microsoft, right, has been lower only 9% of the time. So this is fairly low. I would say that, selling a put credit spread right now at Microsoft is probably not the best. Just simply, again, I'm not saying that this is going to work or isn't going to work, but I just don't think that there's enough premium to justify the risk to do this trade, right? So, and if you are going to use some sort of data to, gain slight edge in the market, right? Looking at just implied volatility, you have to think to yourself, is implied volatility right now going to work in my favor, or is it not? Right. So, but if you think that the price might pull back into these moving averages, and you may expect some sort of a support to come into play, it's not a terrible idea. I mean, pretty high probability. Risk is defined. If you're good with risk reward and the odds, then it's okay. I just don't think that implied volatility is screaming to do this trade. I think this could, backfire just simply because implied volatility might rise. Another way to do or to use this, which is not a terrible idea, really, if you are willing to take shares at 410 and you still don't want to put up $41,000, but you're saying, you know what, if worse comes to worse, I will do it. Well, then you may consider doing this spread. And if the stock really goes down at first, really moves against you, right? Which means the value of both short and long puts are going to increase. You can say, you know what, I was going to buy the stock at 410 anyways, but now I'm going to take advantage of the value of this long 400 put that you bought to define your risk is going to increase as well. You may, let's say, in 2 weeks, right? Maybe the stock goes down to 420, Well, what's 400 put worth, right? 2 weeks later, and about and about 30 points in the money, or 30 points closer to the money, right? Maybe you sell the 400 for a profit, and now you end up in a cash security. You're still willing to buy the stock at 410. You just took advantage by buying this 400 put, right? You took advantage, or whatever you're going to make on this put is going to go towards your total credit collected, and that is going to the amount of credit collected is going to reduce your cost basis of the stock. Because right now, right, this $85 credit only reduces your cost base by 85 cents, right? So 410 minus 85 cents. But maybe if you sold this 400 put on a pullback for like $5, now you have total credit of $5.85. Now your 410 is naked. You're willing to buy the stock at 410 anyways. But now your downside break even, or your cost basis for the stock, is not 410 minus 85, it's 410 minus 585. Right? So it's a little more advanced concept of, getting long shares at, whatever price you're willing to buy them, but there's a way to do it as well, and I think, it could potentially give you a little bit more of an edge, or give you more of an incentive to do a spread at first, potentially get rid of the long leg, and then and then maybe look, the underlying could go down. You dump your long leg, you're committed to buying shares at 410, but then after, a 7 or 8% pullback, the price is going to revert and go back to the upside. Instead of making 85 cents, you will have made 85 cents plus whatever you collect from selling the 400 put that you're buying. All right. Hopefully, I didn't confuse you. Hopefully, this makes sense. If it doesn't, it's okay. We'll get to, more advanced concepts, and we'll talk about all that stuff. So, just a quick recap of what we talked about today, right? You can use put options to build bullish positions, such as short naked put. If you don't want to go naked, you can buy the wing and define your risk. These are bullish options. They're positive delta. They're also negative vega. So you're betting against implied volatility increase. You can also use this as a way to buy shares at lower prices at a discount and get paid in the meantime. You can also use put options to make bearish bets, such as just long puts, right? At the money, out of the money, maybe even in the money. But there has to be a certain reason why you would want to go in the money on the long puts. Maybe it's a stock replacement, or a short replacement for a short stock, right? Like if you go in the money on the put, let's say you buy a 485, which is a delta 88, right? You get minus 88 delta on your position. This is equivalent to being short 88 shares of Microsoft. It's just probably a cheaper and a more cash efficient way to get short the underlying, by going in the money on the puts, right? But if you wanted to just maybe just take a flat out bearish bet, maybe you buy a, at the money or slightly out of the money long put. If you don't want to pay up more, because at the money long puts are going to cost you more, right? You go out and you sell something farther out of the money, potentially giving up downside profits, but you also get to cut your cost by quite a bit, right? So there's definitely ways to use puts to protect your positions. You can also use long puts to replace short stock positions, or you can use puts to get long shares at a discount to current market price, or you can do it with no intent of owning shares, just simply use probability in your favor and generate income in the meantime. All right. Hopefully this is clear, guys. If it isn't, it's okay. I encourage asking questions. Always ask questions. Don't assume that your questions are stupid. Only those questions that aren't being asked are stupid. So Always ask questions. We're here to help you. I'm going to um, put out a quiz. I encourage everybody just to test yourself. There's no, and maybe bragging rights. If you get them all right, good for you. You're ready to move on to more advanced concepts. If you aren't getting all correct, then it's a good way to identify where you need help. Reach out. We are here to help you guys. That's why we do this. So I will put this out. Recording will come out a little bit later. I will attach a short quiz. Take it. Take your time over the weekend. If you have any questions, you can find me on Discord. Otherwise, I'm going to go here. Have a good weekend, everybody. Thank you for your time. We'll pick up next week. Take care, everybody. Bye bye.